Good evening, everyone. I'm Priyanka, and I have with me today our CFO Rajiv Disanayaka, our Head of Finance Anuradhi Dalage, and uh, thank you very much for joining with us today. I'm sure you have seen our numbers. I will briefly go through our financials for the first half, and then we will open up for any questions that you may have. So first, looking at our income, as you know very well, interest rates increased significantly in the second quarter. And let's say from last June to this June, we've seen like a 16 percentage point increase in AWPLR. So this was the main reason for interest income increasing by 50% to 79 billion in the first half. And if you look at loan growth during this period, you can see that on the balance sheet that our loans have grown by about 15% in the first half. But that 15% actually is with the exchange devaluation impact. And if you take it off, our loans would have grown by about 6 to 7% in the first half. And similarly, you see that deposits have grown by 20% in the first half. And if you look at our competition, I think we are one of the we've recorded the highest growth in overall deposits in the first half. So we've seen a shift from CASA into FDs with the interest rate environment, and interest expenses with the rates going up have increased by 35%. You see that NI has grown significantly by 65% to 44 billion in the first half of this year. And as you can see in this third graph at the bottom, you can see that our margins also have improved by about 210 basis points during this period. Moving on to fee income, you can see that our fee income has also grown by about 57% in the first half. This is largely coming from trade income, card income, and also we've seen an encouraging increase in digital transactions. As you know, with the currency depreciation, we've seen a increase in exchange income. This 15 billion you see here is after netting off an impact of about 11 billion, which has come through the exchange impact on our impairment on our foreign currency loans and financial assets. Also, you can see that our insurance premium has grown by 26%, despite the environment that we are in. And importantly, our total operating income has seen a 84% growth during this period. Moving on to the next slide. So this growth in our income has been absorbed by the increase in our impairment. So we've made a total provision of 40 billion in the first half, compared to the 6.8 billion that we made in the first half of the previous year. This 40 billion consists of a 21 billion, or just over 50% is on account of our investments in foreign currency government securities. And considering the operating environment, the economic conditions, moratoriums coming off, we've made a impairment of 19 plus billion on our loans and advances as well. But you can see that impaired stage 3 loans ratio, if you compare, this is one of the best ratios in the industry, and it has improved slightly from 2.55 to 2.46, and our provision coverage on stage 3 has improved to 63%. Moving on to operational expenses, personal expenses have increased by 20%. This is mainly because last year was a collective year for us, collective agreement year. And then in line with that, executive salaries also have got adjusted, looking at uh, the operating conditions in the country as well. And then, of course, the insurance cost has gone up by about 34%. And in line with the, actually compared to a high inflation, uh, other expenses have gone up by about 35%. So you've seen like a 29% increase in our total operating expenses. But given that our total operating income improved by almost 84% during the period, you see that our cost to income has improved at a group level by about 1400 basis points to 33%, and at a bank level to 23.5%. Then moving on to group profitability compared to the first half of 2021, you see that there's been a drop to 6.1 billion. So as I said earlier, this is largely coming from the higher impairment charges that we've made for the first half. So if you look at capital adequacy as a tier 2 DSIB, what is applicable to HNB is 13.5% on total capital and 9.5% on tier 1 capital. But the central bank has issued guidelines allowing banks to draw down 250 basis points on this minimum requirement. So against this, as at end of first half, our tier 1 was at 11.4% and total capital adequacy was at a 14.5%. Our loan to deposit ratio, which was actually around 96%, 95% levels a couple of years ago, has improved to around 83%. Our liquidity levels against the requirement, LCR against a 90% requirement is at 210, and liquid asset ratio is at a 23% against a 20% requirement. If you look at the due point, as I have mentioned, so our income has improved significantly. NII, other income, you can see the increase coming, but it has been absorbed by this impairment charge and the increase in operating costs. That had resulted in our ROAs and ROEs dropping for the first half. So that's the brief presentation from us, and we'll open for questions now.
Hi, this is Ruchir. Can I ask a question, please?
Sure, Ruchir.
Hi, thanks. Thanks for your presentation. Just a couple of questions on your provision costs, which you mentioned in the presentation. So could you talk a bit about what is the outlook you see for your provisioning costs, and what will drive them higher going forward, given the fact that the IMF agreement is in place? So do you foresee similar levels of provision costs going forward?
So, hi, Ruchir, this is Rajiv here. It'll also, the most likely outcome would be that on the ISB side, we may have to increase our impairment provisions in the next couple of quarters. But that again, we will have to see how the negotiations are going, what kind of indications that the IMF will give in their staff level agreement. So there are a lot of question marks, but likelihood is we may have to increase. On the loan side, I think there's a lot of work being done to ensure that the deterioration in bucket movements would be managed, and trying to see whether we can maintain this impairment at these levels or try to reverse. So there is a lot of work being done there. But The likelihood is the ISL impairments will continue, ISB impairments will continue. Hope we believe that it might not be at the same rate that we have seen in the last 6 months, but we need to wait and see to be guided by the negotiations that the government has with the international bondholders as well as the outcome of the IMF agreement.
Okay, so what you're saying is that depends on the haircut on the ISPs. Based on that, you'll have to take more provision costs. Is that the correct? Yeah.
That's right, but more than the ultimate haircut, I guess we'll probably need to see where it is heading. Because I doubt that there'll be a proper resolution or a agreement that will be reached with all parties by end of this year itself. So the indications that we get is that it'll probably take at least another 6-7 months before a final agreement is reached with all the creditors. But the based on how the negotiations are heading, we may get an indication as to how much we need to look at.
Correct, correct. And so then how comfortable are you with your capital position? So, I mean, if you're going to take more provision costs, assuming on the ISBs, then, I mean, is there any need to raise equity capital in the future?
So for the moment, we remain still one of the highest capitalized banks. So it'll all depend again, Ruchir, on the amount of impairments that will need to take, how much of a haircut that ultimately come through, and how soon it'll come through, whether it'll happen this year, whether it'll happen next year, and how that is going to come by. So uh, I would say that there is a possibility that we may we may have to look at equity infusion, but it's difficult to say at this point in time because we don't know how much of a haircut that or impairment that we will need to take. And in addition, even now we are about 100 basis points above the minimum capital requirement. In addition to that, there is also another 2.5% that central bank has allowed banks to draw down on the CCB. So hence there is no immediate threat, but then we'll need to wait and see how the discussions go. If the haircut is much higher than we would have initially anticipated, then we might have to look at. And there are also, given the current environment, I believe there will be some kind of a regulatory forbearance that will also come through, where we will be able to, over a period of time, agree with the regulator how we are going to get into some level. So there is a lot of question marks at this point in time. The haircut, what kind of regulatory forbearance that will be there. We already have about, with the CCB, about 3.5% more capital uh, percentage points that we have as an excess. So we wouldn't know exactly at this point in time whether or when we will need that, Ruchir.
Okay, great. Thank you. This is very helpful. Thanks.
So I think overall we have close to about 17.5% loss ratio that we have taken on our ISP portfolio as impairment up to now. There's a question on why the borrowings have come down. So borrowings would have come down as a result of probably repo borrowings going down. And of course, the foreign borrowings, some of the foreign borrowings that we have had, those have been gradually been repaid. And given the current scenario, we have not been able to borrow from foreign banks. So therefore, you haven't seen a increase in the borrowing portfolio. So that's the reason why borrowings have been going down. So on ISPs and SLDB impairment, there is a deferred tax asset that we have created. There's another question, CBSA report next. So this includes undrawn limit. You're asking what is this undrawn portion is? It includes undrawn limits that have not been utilized yet. So I think there was a maturity on SLDBs. There's a question in terms of how much we have got in rupees. There was a SLDB that matured, I think, in May or June, $20 million. We got that in rupees. So what is the sentiment on obtaining new loans? I believe if you look at even loan book, you'll see that we have not aggressively been growing our loan book. So the demand for new loans are coming down, and we are also fairly conservative in giving no loans. So you probably see the deposit growth being fairly high compared to the loan growth in the next few months. So there'll be a significant slowdown in the loan growth. So this could be the revaluation effect, I believe, because the dollar cash balances that we hold would now get revalued at the 365 rate. That could be the reason that you're seeing an increase in the cash balance. So there is, I think governor has come out very strongly saying that he's not looking at any DDRs, which is domestic debt restructuring. And I believe there were a few articles yesterday as well from Dr. Kumaraswamy and W.A. Vijayawardena saying the implications that could have on the country and the economy if you do take domestic debt restructuring. So we don't see, at the moment, we don't envisage a DDR, and hence we have not made an impairment on it. Anyhow, most of our local currency investments are in treasury bills, and treasury bond investments are significantly low. So the impact would also be somewhat lesser even if it happens, because most likely, even if there is a DDR, it will mostly be on bonds and not on bills. So the impact would be less, but no, we have not taken an impairment expecting a DDR. There is a question on, could you give an insight as to how the reclassification of OCI instruments to amortized cost was done? Have both bonds and bills. I have here Anuradhi with me, head of finance. She will explain.
In accordance with the SOAT issued by the Institute of Chartered Accountants, we have reclassified the both LKR denominated government securities and sovereign bonds, previously classified as fair value through OCI, into amortized cost category. We've done it with effect from 1st of April 2022. This is in line with the Institute SOA.
So most in terms of variable fixed and variable rate loans, most for corporate and SMEs would be variable rate. So I would say 70 to 80% of our loans get repriced within a period of 1 year. So that's why you have seen that our margins have really shot up with AWPLR moving up. In addition to that, as I mentioned earlier, most of our government security investments are also in bills in short duration. Only on the retail side, we have we have a portfolio in fixed rate that is in leasing, housing, and some personal loans. But most of corporate, I would say almost 100% is in variable, except for maybe one or two project loans. Even in SME, majority would be at variable rates. If there are no other questions, thank you everyone for joining us for this session today. Hope to meet you all again at our third quarter performance update. Thank you very much. Have a great day.